Okay, we're going to get started today by looking at the S&P 500. We can see that the S&P chart is bouncing above the 20-day exponential moving average. We've used this line as our indicator if this current trend is continuing. And you can see that when we get close to that average, it bounces up a little bit. So as long as the um, chart remains above the 20-day exponential moving average, the general market movements are going to be going up. We're going to watch to see if it crosses through that and through some of the other moving averages to determine if we're in a totally different trend downward. But right now we are definitely in a upward trajectory. Okay, let's look at some of our meeting notes for today. Oh, one more thing. The reason why we go over this S&P chart every week is the first thing that we do. It's very important because 90% of the stocks in the stock market follow the S&P 500. So if the S&P is up for the day, there's a good chance that a majority of the stock market is going to be up also. So when we're looking at individual stocks, we like to um, go with a trend. And right now, it seems to be a decent time to be buying and holding. Let's look at our meeting notes for this week by starting to look at our calendar. You can see in our calendar, there's not a whole lot going on this month as far as earnings. Um, we had some government reports this week, but in general, it's pretty quiet. The S&P is basically flat for the week. It didn't do anything. So let me see. So we have end of quarter window dressing. That is every 3 months. We have, you can see right here in March, at the end of March, at the end of June, and at the end of September, and at the end of January. We have end of quarter window dressing. That's when mutual funds, um, hedge funds, money managers, they want to buy the best performing stocks in their portfolio. So they pad their portfolio in the last week so that whenever they have their top 10 holdings displayed to the world, um, it looks like they're geniuses because they have the best picks of the year so far. So that's going to make the next couple days usually positive. So keep that in mind. And you can see in October, we're coming into earnings season again. Just when we thought we're done with earnings, it starts all over again. And with the banks start reporting the week of October 12th. That's 2 weeks. All right, and then then we start getting into the tech earnings, starting with Apple and Google in November, and then NVIDIA at the end of November. So we have that to look forward to. You can see that October is traditionally a good month, seasonality-wise. Highlighting that now, it's usually up a 1%, going back um, since 1980. And you can see that October is one of the most volatile months also. So be ready for the stock market to go up and down, a lot because that's the way it is this time of the year. October has been famous for crashes because some of the largest crashes in the history of the stock market have happened in October. So there's a little bit of uneasiness whenever October comes around in the stock market because a lot of participants are leery that that crash may happen again. Um, November, December are great months because we have three major holidays. We have Thanksgiving, we have Christmas, and New Year's, all within a very short amount of time. And in general, the theory is right around the holidays, people are happy and they have a tendency to buy stocks around that time. So let's see if that seasonality happen or works out. Um, this year. Doesn't happen every time, but most of the time seasonality works. It didn't work this month because September wasn't the negative month I was expecting. It was up actually 3%. So this is the first major difference from the norms seasonality wise. Um, let's see. Okay, let's see what else we have to talk about here. Okay, so we had two earnings reports come out this week that were major. One was Micron. Micron sells memory. Specifically, one of their highest growth parts of their business is high bandwidth memory that they're selling to artificial intelligence development. And they came out with better than expected earnings, but their stock went down. So it's kind of a buying the rumor, selling the news. Costco came out with earnings, and it was disappointing. And they are trading at a super premium to this stock market. Um, they have a PE ratio of 50, and they're only growing around 10%. So that's 5 times overvalued, but they've always traded at a premium. So the one problem with Costco is if they do miss their numbers like they did this past Thursday, the stock could go down quite substantially if they can't continue that 10% growth over time. So we'll keep our eye on Costco, see if it ever goes on sale. All right, let's look at the earnings that were coming up this coming week. We have Carnival Cruise Lines. That gives a indication of how the consumer is spending. There's a lot of discretionary spending on cruises. And then we have Lamb Weston. This is the largest French fry maker in America. We have Paychex. That gives us an indication of how the labor market is going. And we have Nike. Nike is we've been following that, but it's truly um, been disappointing as a stock. It's been going down in like a straight line. But they have a lot of competition with Lululemon and ONN. There's a lot of new types of shoes coming out. So I've stopped following them because they're pretty pricey. Let's look what else. No, that's about it. So this is basically the end of earnings season. Um, so we'll have to pick up on earnings season in a couple of weeks, the new round of earnings. All right, so let's look at some of our numbers. S&P is basically unchanged for the week. 62% of stocks are over the 200-day moving average. That's neutral momentum. What I did was I put together this week what that means. What is the percentage above the S&P? What does that mean whenever you have 62% of stocks above the 200-day moving average? If it's over 70% over the moving average, that's a bullish market, meaning a large majority of stocks are trending upwards, signaling a broad market strength. And if the number of stocks in the S&P above the 200-day moving average is less than 50%, less than 30%, that's a bearish market. That's an indication that most stocks are going down and they're consolidating, and it signals market weakness. So right now, being over 62, that is close to our our bullish thesis, meaning it's okay to start accumulating, thinking that the stocks are going to continue to go up. And let's look at the 10-year. It's up 1% since last week. Okay, so that's a lot. The 2 years unchanged. So when we're looking at our indexes and the stocks going up and down, we're going to keep in mind that the 10-year is up 1%. You can see in our chart here, this is the yield of the 10-year. It's going up, and the stock market usually goes down it's inverse correlation, but it wasn't an inverse correlation this week. It basically was flat. The S&P was flat this week. So let's see if that continues, this inverse correlation. It seems pretty reliable so far. Okay, so let's look at the trend line for the S&P 500. You can see that the trend line is basically a perfect upward trajectory. We're at the bottom end of our trend line right now. This is as low as you can get. And we're basically, stochastics are at about a 70. So we're overbought, starting to go down. So we're neither over, so doesn't seem like right now we have a good idea whether we're going to be going up or down in the stock market right now. We do know we're above all of the moving averages, which is positive. So when in doubt, I think we're going to be going up because we're above the 20-day exponential moving average, this yellow line here. And that's been a form of support for the market going back since April. Okay, so let's look at some of our major variables to the stock market. The price of oil is up 4% since last week. So we've seen the dollar go down for a long time. And we're still in a downward trend in the dollar. Usually when the dollar goes down, the price of commodities go up. So maybe this is a delayed reaction. Maybe it's finally starting to go up, but you can see that the oil and energy stocks are starting to catch a bid, and they're going up quite a bit recently. So let's see if that trend continues. Inflation is at 2.92%. That's the same as last week. We still have tariff pressures. If we look at the front page of the Yahoo Finance, you can see one of the major stories. Hold on. Okay, one of the major stories from this week. It isn't on here. Okay, well, the story was that the United States is putting 100% tariff on, see, finance. We're looking at Yahoo instead of Yahoo Finance. Okay, so Trump's 100% pharmaceutical tariff won't apply to the EU and Japan. So basically, the Trump administration put on 100% tariffs on branded drugs from companies that don't manufacture in America. So that is a sign that this tariff story is going to continue. So as the tariffs continue, that's going to put pressure on inflation. Okay, so let's look at our dollar index. It's up 1%. So the dollar has strengthened this week, and gold is up 2%. So why is gold up 2%? Okay, we have two reasons. One is the dollar. Let's look at the dollar index. Yeah, it's continuing to go down. It's up a little bit this week, just a little bit. But one reason gold is going up is as the dollar depreciates, all commodities prices go up. And also, it seems like central banks around the world are accumulating gold. So there's a steady demand from central banks around the world. So gold is one of the best performers this year. It's up like 40 some percent. So we're going to keep an eye on gold. Also, there are talks of the government shutting down. And as that happens, people get a little nervous and they go to something that's more conservative. And gold has held its value over time. So as fiscal responsibility and the government debt come into focus with these the talks with the budget this week, you're going to have a bid on gold because that is a protection against any devaluing of our currencies. All right, so let's look at what else we have. Okay, the fear and greed index. We're down to neutral. We were greed last week. So the market is getting a little bit more fearful since last week. So we don't have any action to take. We like to be contrarian. Whenever people are extremely fearful, we're looking for things to buy. When people are extremely greedy, we're looking to sell some or don't buy. So there's a little translation. Right now, we're right in the middle. So we're neither positive or negative for our tendency to buy. Let's look at the amateur investor. Amateur investors are bullish this week. So our translation, when the amateur investor is bullish, we take profits off the table or don't buy. So we have a little bit of contrary indicators there. We have neutral in the fear and greed index, and we have bullish in the amateur investor survey. Okay, so let's look at the VIX. The VIX is 15. That is very low. The market is not afraid and not fearful that the stock market's going to be going down or have a lot of volatility. That's interesting because this time of year is one of the most volatile times of the year. So we expect the VIX to go up, like maybe to 20 sometime, in September and October, but we'll see if it happens. Okay, right now, I think in our emotional graph, we're about at the top here. We're still at the delusional, greedy, amateur investors are excited. And the stock market continues to go up. So, and everyone's excited about AI. So we're at the top of this emotional feelings right now. Anything that could cause the stock market to crash right now, anything tariffs, like this pharmaceutical tariff, could cause a crash. We could have any government actions like this week, the Trump administration said Tylenol caused autism, and that caused that stock to tank. So, I mean, Kenvue to tank. So, government action, we have tariffs and possible cracks in the AI story. We do have some cracks showing up in the AI story this week where NVIDIA they invested in companies that were buying their product. So it's like a circular kind of it's a very cheesy situation in AI where NVIDIA is investing in a company that's buying their chips. So that happened in the .com era and where there were vendor financing, it's called. So the vendor finances purchases and it's just a hint that this could be similar to the crash of 2000. So we'll keep an eye on that. If there's any more hints that there's a cracks in the AI story, I'll bring them up. All right, so we're the S&P is trading at a 25 PE right now. That is basically a very high level. It's very, very expensive right now. Only 4 times in the past 100 years has it been that expensive, and usually that's around times where the stock market corrected. So you have to realize right now it's going to be volatile, and you expect maybe a 20% retracement if we had a bad news story. And that's part of doing business. You have to be ready for these ups and downs. Okay, let's look at the first to worst. The first to worst. It seems like the best ones from last year, these communications and IT, are the best of this year. Primarily because they have the highest earnings, these sectors, and the highest the highest earnings growth profiles. And look at this. Consumer discretionary last year was up 30%, and now it's the worst performer of this year. Down, it's up 4% this year. And look at this. Energy has gone up 5% in the last week. So it's starting to make a comeback with the price of oil going up. So we'll keep an eye on that. It's in an uptrend. Let's actually look at our charts for the indexes right now. Specifically, let's look at the XLE. You can see XLE, where is it? There it is. You can see we're in an uptrend right now. And this is probably one of the stronger charts right now. You can see that it's probably direct correlation to price of oil going up. So this is energy sector. Let's look at some other sectors. We have XLP, Consumer Staples Selector, totally out of favor, oversold. Okay, so if we have any kind of volatility this month, which we usually do, this sector could have a bid. Right now, we have the stocks in the consumer staples sector are very conservative stocks that pay dividends, and they're very reliable usually. They're out of favor right now because most likely because the tech stocks and the high growth AI plays are attracting a lot of the dollars. But right now, as interest rates come down, the stocks that pay a dividend might be in vogue. And you can see, look at this. We have a triple bottom in the last year. You can see that once it hits this level, it kind of bounces a little bit. So going back a year, going back a year, you can see this sideways pattern. So it looks like we're going to be, going up and down like this for quite a while. But if you're looking for a dividend, the stocks for your portfolio, this is a good sector to start choosing from. Okay, let's look at industrials, utilities. S&P is up 13%, and the financials up 11%. Okay, so in the worst performing sector is real estate, probably because the mortgage rates are still stubbornly high, and that's not helping the housing industry. And also the 10-year has been going up recently also instead of going down. So that is hurting real estate. Healthcare, we get stories every day from the Trump administration about how the possible tariffs on pharmaceuticals. So that is really hurting that industry and causing it to underperform again. 3 years in a row, we've had underperforming healthcare sector. When will that stop? I don't know. But it seems like the rules the government are placing are really hurting these companies. Okay, energy. Okay, let's look at some of I haven't updated this in a couple of weeks. It hasn't, this link right here hasn't updated. So when it updates, I'll talk about it. But in general, consumer discretionary stocks have a very high PE ratio, 30. So they're very pricey compared to history. And the same with IT and industrials. Let's look at some of the stocks going up and down today. We see, okay, well, let's go back to our 10-year. You can see that the 10-year has been going up this week. So when the 10-year goes up, let's look at our cheat sheet. Yield of the 10-year going up. That's good for large cap tech stocks because they don't need to borrow. Financial sector and insurers. It's negative for companies that need to borrow money, small cap stocks, indebted stocks, high yielding high yielding stocks are not going to do good because as a guaranteed 10-year investment goes up in yield, the demand for a high yielding stock goes down. Home builders, cost for mortgages payments go up as the interest rates go up. So home builders going to take a hit, and REITs and speculative biotechs, etc., are companies that need to borrow to continue their operations. That they're going to get hurt. Let's see if that happened today in the stock market. When we look at the market movers in the sectors, okay, while we're waiting for that to load, let's look at the market movers for stocks. We have Electronic Arts up 15%. There was a story that they're being taken private. So whenever you get a story like that, it's up 15%. You can't touch it because you got to say to yourself, I missed it. Um, I'll be ready for the next time. Because if you buy it right now, there's a slight chance that that doesn't go through. Maybe um, some kind of antitrust compliance or whatever. So you don't want to buy a stock when it's up 15% on takeout news. That's just the worst time to do that. Um, so let's look at other stocks that are going up. App 11, we've been talking about this for a couple months now. This has been in our list of our stock screener list. It was added to the S&P 500, and it's pretty pricey, but it seems like it's still growing. Lamb Wesson, this is an example of the stock it's going to report their earnings next week. They're the largest French fry maker in America. Intel continues to go up. Um, this is an example. This is an example of a stock that their fundamentals are horrible. I mean, they're inconsistent. They're losing market share to competitors, but the Trump administration invested money in the company, and they had a lot of good news about um, possible NVIDIA investments in the company. So what we have here is this is one of the largest semiconductor companies made in America. I mean, they're making their chips in America. So there's a big push for companies to create their chips in America. We should have saw this, a couple months ago, because if for some reason there's a Chinese takeover of Taiwan, um, America is going to have their chips made locally, and this Intel would be the beneficiary of that kind of need. So I missed that. Tesla is a very similar situation where Tesla's fundamentals are horrible, but we can see maybe 5 years down the line, they'll be making autonomous robots and robo-taxis. Um, I haven't taken that step yet to invest in companies with horrible financials. So we'll keep an eye on this kind of story in the future. Okay, Tesla's up 4% today. That is pretty amazing. Their stock is very overvalued. They have a 150 PE, and they're only growing maybe 40%. That's 3 times overvalued. Boeing, they're getting orders from the Trump administration's going to countries and making deals. So Boeing's getting a lot of orders, but they can't make their planes fast enough, it seems. They have a backlog of like 15 years of planes they can't make. So we talked about Boeing last week, actually. Let's look at the chart of Boeing. This was an example that we brought up of a, hold on. Okay, there it is. Um, okay, last week we were saying Boeing is oversold. You can see that right there. And they're at the bottom end of their trend line. So basically the news hit that maybe they got a lot of orders from overseas. And that's going to make this chart go the whole way up to here next, maybe. So we'll keep an eye on that. Okay, we finally got our, okay. Let's look at the stocks going down the most. You can see Costco, they had an earnings report and it wasn't as good as expected, so it went down. Oracle's in the news because they were involved in the TikTok buyout or whatever they call that. Um, I'm not sure. Well, there's a lot of profit taking because the stock ran up 30% in the last month. Um, eBay's down 2%. Okay, First Solar. Um, seems like the current administration is against anything renewable. So right now the trend is down for anything renewable, and the trend is up for oil because the Trump administration is going to favor oil over renewables. So we're going to see. Let's okay. That's it. That's a good exercise. Let's look at the market sectors going up and down. Okay, all sectors are up today. Gold sector is up the most, probably because the price of gold has been going up. So the gold miners and home construction, that's interesting. As the interest rates go up, I expected home construction stocks to go down, but they're up. And healthcare is up 1%. Okay, so they pay a dividend. I expected them to be going down because as the 10-year yield goes up, demand for high yielding investments go down. So my theories didn't work today. This yields of the 10-year going up positive for it totally flipped today. This didn't work. So everything, the small caps, high yielding stocks, home builders are going up, even though the yields are going down, are going up. Okay, so let's look at what's down the most. These telecom, that makes sense because telecoms, they are high yield. And as the interest rates, the yield on the 10-year goes up, demand for the high yielding investments go down. So high yielding stocks. Okay, so negative for those. So that's why it worked for this one here. All right. In consumer staples, they pay a dividend. That's why they're down the most. And that's what we got from that. All right, so let's look at our next. Okay, so let's look at Dan Now's picks from the beginning of the year. KBWB, the large bank ETF, is up 21%. That is the best. We have Cisco up 13% and ADTN up 11%. The IJJ mid-cap ETF is up only 4%. That is his worst pick. Let's see why he chose this IJJ. He said new U.S. policies benefit mid and small cap value. Okay, so this is a mid and small cap value fund. The problem is that interest rates have been stubbornly high, and that's negatively affecting these companies. let's look at why he said at the beginning of the year why KBWB, the large bank ETF, would go up. He said deregulation, net interest margin grows, and active capital market. So that was his best call. We do have an active capital market. IPOs are going crazy whenever they're IPO'd, and we have a lot of IPOs this year. Deregulation is definitely a theme this year. Net interest margin grows. Okay, so we have lower interest rates, and that's helping them be profitable, the big banks. Okay, that was a good learning lesson. Now, let's look at some of our stocks that I found interesting. Look at Amazon. Amazon has a uptrend right now, starting way back in March, but you can see it's oversold right now, and it's at the bottom part of its trend line. So, so let's watch that to see if it bounces up. And we also have the stock intersecting with all of its major moving averages. So you can see this green line here. That's the 100-day moving average. This purple line is a 200-day moving average. So these two moving averages are support for a stock. So whenever it hits that, in addition to this upward trend line, that's a good indication this is, a good time to start buying a stock. Everyone watches Amazon. So the theme for Amazon is their most profitable segment is their AWS, and it's growing probably 13% a year. It's getting competition by Microsoft's Azure, and Azure is growing at 30% a year. And that's might be why they're out of favor right now, because it's not growing as they had expected to grow. Let's look at our next stock, Apple. You can see that Apple's been in an uptrend for the past since April. You can see that it's starting at 2025. It is where it is right now, basically. So year to date gains are like zero for Apple. A lot of times when you have this prior resistance, this is resistance where it's at right now. You can see that's might be why the stock has stopped right here. So we might have the stock go down maybe 2 or 3% to the bottom end of this range to continue this zigzag upwards. So we do have this resistance from the prior highs and from the beginning of the year. And we do have a lot of volatility coming up this year. But they did have a really good September 17th show where they have new products and people are excited about it. And they do have a new iPhone that's slick. And if we break out of this trend line here, then there's a good chance that it could go up to here, because we basically had this sideways pattern for a good part of a year now. So we'll see. We're at a decision point in this stock, because we're at a resistance and we're at the top of a trend line and we're overbought. So let's see what happens next. Next one is Procter & Gamble. You can see that we're in a defined downtrend in this stock. And you can see that we're oversold, and where the interest rates on the 10-year are going up. That's making it harder to invest in dividend-paying stocks. I'm going to start looking at the fundamentals of this stock, because this is one of the worst charts in the whole stock market. They're in like a turnaround plan right now. They're executing a turnaround plan. They're reducing their product line and putting advertising towards some of their favorite sectors. So I'm going to start looking at this one to see if it's investing, if my thesis is still correct. Okay. My thesis for Procter and Gamble is um, they have #1 market share in a lot of their products. And if they up their advertising, and they'll sell more of that product, and they'll continue to give a 3% to 5% dividend over time. This is more towards the dividend part of my portfolio. So I'm very concerned that, they're going to continue to at least support that dividend over time. Let's look at Verizon. You can see it's in a sideways pattern um, for at least the last year, and it's oversold right now. You can see that. Um, and it's at most of its moving averages for support. So it's down a little bit recently because of the 10-year going up. But let's see if it continues this trend of sideways pattern. They're only growing at like 2 or 3% a year, and they're losing customers to T-Mobile. So, and they have a lot of debt. So this stock has a lot of warts. Um, I'll have to start looking at this one also because it's basically going nowhere after 5 years. Let's look at this this is a tweet by Bloomberg. It says stocks rise when Fed cuts rates outside recessions. Okay, so that someone else put a chart up on Twitter that basically said whenever rates are reduced and it is not a recession, in the next year, the stock market is up like 95% of the time, and it's usually up like 20%. So we have, when we're looking at our our charts and determining where we think stocks are going, in the next year or so, we have to understand that the interest rates are very important in determining if stocks go up or not, because as interest rates go down, the cost of borrowing goes down also, and that makes stocks more profitable. And the stock market, people pay more for stocks when interest rates are lower. So this is a good sign. We're gonna see if this is true over the next year. I did a stock screen again. We have our typical names at the top of our list. I organized this list by market cap. But I also highlighted the best 15 or so stocks in every category. So the green means it's the best, one of the best 15, and the yellow means it's 15 to 30% good. So I highlighted a Micron. This is very compelling to me because it has a PEG ratio of 0.3. And that indicates it's like 8 or 9 times undervalued according to Yahoo Finance. Now, this is Fidelity's screen. So I thought it'd be interesting to go over Micron just so we can learn a little bit more about that stock. Micron has always, for at least for the past 15 years, sold for a PE that's very low. Right now, its PE is 9. And when almost every other sector in the semiconductor, every other stock in the semiconductor industry is selling for like 30 or 40 or 50 PE. So they don't get a whole lot of credit. Um, their stock trades at a very low value. And that could be a reason for that. Um, so I thought it'd be interesting to look at Micron just as the focus today. Let's look at the stock right now. You can see it was in this sideways pattern for at least half a year, for 3/4 of a year. And then it kind of right here broke out of that sideways pattern, and we have like an uptrend now. It reported its earnings this week, and it went down like 5 or 10%. Even though the numbers are pretty good. But you can see this Yellow exponential moving average, 20-day exponential moving average. It's following that, the stock is basically following that to a T. And it's a little bit overbought right now. So I would tend to wait for it to go back down to the bottom of this trend line to start buying it. But we'll see a little bit very soon that seems like it's like 9 times undervalued. Even though they have the tailwind of being a major supplier of memory, high bandwidth memory to the AI infrastructure trade. So it seems like it's too good to be true, and that's why I'm going to research it. Let's look at the 10-year chart of Micron. You can see this is a very volatile stock. It goes, you know, it goes up and down a lot, primarily because their earnings are not consistent. This is like a typical cyclical stock, meaning it goes up and down with the economy. And you can see that right now we're just like Apple, we're meeting a resistance level that we were at April 2024. So we're kind of in the same situation where we have resistance, prior resistance, and we're trying to blast out of that, but we're still at that level. We could be in a sideways pattern like this, but if you invest in a stock like Micron, you got to be ready for that stock to go down to $10 a share and then go back up to $150 a share, because that's just the way this stock trades. And if it does go down to $10 a share, I guess the reason you have to be willing to buy some more. The reason why that this stock is so volatile is the earnings are pretty inconsistent, as we'll find. Some years it has positive earnings and some years negative earnings. Let's look at the earnings estimates going out a couple years from now. You can see that from this year to next year, they have 94.1% growth. And then the year after, they have 11% growth. And the year after that, negative 4%. So the story of this stock is it's very inconsistent earnings. But they have a huge tailwind with being a major memory supplier to the AI infrastructure. So if they're, right now their PE ratio is 11. And if they're growing at 94% from this year to next year, that means their PEG ratio is 0.11. If you divide growing 11 by 94, that is 9 times undervalued. The problem is they're not going to be growing 94% for the next 3 years. They're growing 11% and then negative 4.2. My gut says that the analysts have been wrong on Micron for every year that we've been following them for years ahead growth. So I'm thinking if this AI infrastructure continues, the story continues, we're going to still have 94% growth going forward. But a lot of analysts don't want to put their neck out and make those predictions, I guess. But we'll take it for what it's worth. If it was 11, if earnings growth are only 11%, then if you have 11% PE, 11% growth, a PE of 11, the PEG ratio is 1, so it might be fairly valued. So it seems like it's trading right now as if it's going to be trading 11% growth forever. If we look at their numbers, it has a pretty low market cap. It's like a mid cap, 175 billion, and the 4P is 11. According to Yahoo Finance, the PEG ratio is 0.16. That matches our numbers. So let's look at the other numbers. You can see the profit margin is double what we're looking for. It's at 22, and the return on equity is 17. That's better than the 13 we're looking for. They have 5 billion in debt. So 5 billion out of 175 billion, that is a very small amount. So we're not going to worry about that. And they have negative levered free cash flow. I like to see positive here, but you can see they have a very small dividend too. So I thought it'd be interesting to see what CFRA says about it because I trust their opinion the best. They have a buy rating with a $200 price target, which is more than it is now. You can see their investment rationale risk. Our buy view reflects valuation and belief that memory space grows through calendar year 2027. We believe Micron's upside will be supported by the secular growth in AI, which has created robust demand and a tight supply environment for high-value memory products, particularly high bandwidth memory, now at an $8 billion annual run rate. Data center revenue constitutes 55% of total sales with impressive 52% gross margin. So they're making more money on the highest growing part of their business, high bandwidth memory. Memory fundamentals remain robust, driving profits with guidance implied gross margin expansion over 51%, highest in 7 years. We think Micron is executing on structural shifts in the DRAM space, technology leadership, witnessing favorable market conditions versus tight DRAM supply. Okay, so they think that the thesis is intact. Let's look at whenever Micron had their earnings come out this week, CFRA usually puts out a little note, about, what they think of the stock. They maintain their buy opinion. They say we lift our target from 155 to 200 on a PE of 10.6. With this 10-year historical range below peers. Okay, so the PE of 10, that's what I was saying. The PE of 10 is a lot lower than the PE of 30 or 40 of Micron. They say after it posted August results that exceed our views, we raised our guidance estimate to $16 a share. We believe Micron's upside will be supported by the secular growth in AI, which has created robust demand and a tight supply environment for high-value memory products. Okay. All right. So they have they maintain that it's a good stock even after earnings. Now, let's look at the CFRA's fair value. This is amazing. I've never seen something like this before. They say analysis of the stock market's worth suggests that Micron is undervalued by 165.04 or 99.18%. They think it's worth double what it's trading at right now. So that kind of matches my estimates. I thought they were 9 times undervalued. So they say it's 2 times undervalued. So look at this. These are concerning things to me, though. Look at this. Earnings are negative 4, 11, 5, 2. It's all over the place. And then it's negative again in 2023. This is why they have a low PE ratio because their earnings are inconsistent. And their revenue is very similar. I like to buy stocks where they're 10, 20, 40, 60, 80. But look at this. It's not in a straight line. It's kind of all over the place. And the return on equity isn't consistent either. So the good stocks, they'll have a return on equity, maybe 5, 6. It's getting better over the years. But we have a negative 12 and we have a 1. So it trades for a lower multiple because it's inconsistent. Let's look at what Morningstar says about it. They say Micron's results exceeded expectations and revenue rising 46% year over year. Management guided for more than 40% year over year growth. High bandwidth memory exceeded 2 billion. Okay. Their guidance for continued rapid growth far exceeds our estimates and implies a torrid rate of artificial intelligence investment continuing. Micron is one of the two leading high bandwidth memory suppliers, and it's gaining share against Hynix, their competitor. Should forward boost its growth. They say it's overvalued by 11%. So that's contrasting to the CFRA. So okay, so that's a good for Micron. This I like the idea that's in the AI world that is growing like gangbusters. I like the idea that we have an undervalued major player in the bandwidth memory, high bandwidth memory for that sector. It's like a um, it's a high growth area that everyone wants to try to get into, but this stock doesn't get any respect, it seems. It might not. It may be 5 to 10 years from now, it's still going to be trading at a 5 PE. I don't know, but I think this is worth me putting in like a 0.5%. And looking at this stock, okay, looking at this stock like right here, I would put in like a 0.5% when it gets down to maybe its 20-day exponential moving average. If it gets down to here, I'll put like 0.25%. And if it ends up dropping down to here, I'll put in like 1%. That's kind of my plan for this, because you gotta expect it's topping out right now, and it's gonna go back into this pattern right here. I don't know, but it seems like it's undervalued. It just doesn't get any respect, and it might never get respect. We'll see. Okay, here's a new Wall Street Journal front page. Walmart CEO issues a wake-up call. AI is going to change literally every job. So we have more and more companies that are, I mean, this is a pretty big company, Walmart. For them, a very conservative company. For them to say AI is helping them, that adds credence to our long-term AI thesis. So when we're looking at Micron being a major bandwidth, major player in the memory for AI, and every day AI is being accepted, and we have more evidence that it's being used and it's actually useful, that could help that story some more. So I like to keep an eye on these stories as your thesis plays out. Another story that came out, inside the Tylenol crisis at Tylenol, the CEO behind Tylenol thought he found a way to work with Trump. Everything is now off the rails. So basically, the current administration is going after Tylenol as a major cause of autism. And it's weird that the maker of Tylenol is Kenvue. They were spun off of Johnson & Johnson in 2023. And it seems like all the scientists in the world are saying that there is no connection. They won a lawsuit where there was a lawsuit that Tylenol caused ADHD, and there was no proof, and they won that. Now the Trump administration is taking the losing side to that and saying that the Tylenol is a cause of autism. So the stock dropped like a lot. The Kenvue stock. I thought it'd be interesting to look at the stock Kenvue. Okay, so this Kenvue, they're a very low growth stock. This is not for a growth part of your portfolio. This is more of a dividend idea. So this company pays a 5% dividend right now. They're growing let's say around 8%. And if you add 8% plus a 5% dividend, that's a total return of 13%. And their PE ratio right now is 14. So the PEG ratio is like 1.1. So it's a little bit 10% overvalued right now. According to Yahoo Finance, they're like 0.83%. So Yahoo Finance thinks they're 17% undervalued. But it seems like this is, this seems like a very reliable stock. It's like a consumer staple. People need these kind of drugs. And Tylenol, I got a couple charts later. Tylenol is okay. You see the most popular consumer health brands. Vicks from Procter and Gamble is 41% purchases. Tylenol is 40%, of the purchases, and Mucinex is now 30%. Okay, so it's in the number one, number two best product of the market. Whenever a stock that has the best product of the market, goes on sale, I want to look at it. The problems, there's a couple warts with this stock. One is that they have potential lawsuits from this. We have brand damage from the Trump administration. Who wants to buy Tylenol when it could cause autism? Will it cause autism in me whenever I take it? And you have a loss of confidence. So let's look at some of the fundamentals on this. Okay, the market cap is pretty small. It's 31 billion. The forward PE is 14. PEG ratio is 0.8. The profit margin is 9. That's pretty decent. I mean, that's near the 11 that I look for in a growth stock. The return on equity is 13. That's exactly what I'm looking for. So we have a decent stock that probably is going to be paying a dividend, for the next 20 years. So for a 5% dividend, that is pretty good, if you can handle the warts. Total cash, they have 7 billion in debt right now, which is it's pretty big. Out of 7 billion out of 31 billion. That's like 1/4 of their market cap is in debt. So they'll have to get rid of that debt eventually for them to be a little bit more profitable. Okay, so they are profitable. They have 2 billion in levered free cash flow. That means they could probably pay this debt off in like 3 or 4 years. After they pay their dividend. All right. So let's look at some more information on this. Tylenol is 15% of the total money that they make in this company. That is pretty big. And Neutrogena is the biggest seller, and Listerine is 11%. So this isn't a minor thing for the company. This is 15% of their sales. There's a link here you can click on and watch it. It's basically them talking about this situation. Could this be a stock that you buy for a long term? And they basically said in this video that the stock doesn't come without perils. I mean, there could be lawsuits, there could be brand damage. Maybe the amount of people buying the Tylenol goes down. It's amazing that the current administration went after Tylenol when the active ingredient in Tylenol is used in a ton of other products like NyQuil, and they didn't say anything about other products that have acetaminophen in it. So this is an example of a very similar to the stock market crash at the beginning of this year in April. Trump comes up with like this hot air about tariffs, and then he backtracks on it, or it kind of turned. This is very similar in that he comes up with a story about Kenvue of the Tylenol causing autism, and there's no scientific rationale behind it. So it could be another example of fake news that makes a stock go down that's a quality stock. So we don't know about that. So um, let's see what CFRA says about this. They say, our buy recommendation reflects a buying opportunity following the stock's sell-off from administration allegations linking Tylenol to autism, lacking credible scientific support. Tylenol represents 10 to 15% of total sales, with prenatal use only 5%. Prenatal use is only 5%, 3 to 5% of Tylenol revenue. Kenvue's board initiated a strategic review examining optimizing the company's brand portfolio, addressing self-induced complexity, including 115 brands where only 41 contribute meaningfully. We view this positively as it could simplify operations and make concentrated resource on strongest brands. That's exactly what Procter & Gamble is doing. Okay, so they think it's a bunch of BS. Let's look at, let me see. Let's look at what CFRA says about it. They said that it's basically 30% undervalued right now. The fair value, it should be 24.5. They said, Kenvue press release, soft tone on. Okay, so basically they were expecting something like this. Back September, they mentioned Tylenol autism, but they said we're going to release something later. But they basically, Morningstar says that the press release by the Trump administration this week was softer than expected, meaning it wasn't as bad. They didn't say don't use Tylenol. They didn't ban the product. So it's better than expected. And they said the shares are still cheap. They said that the U.S. Food Administration will begin a process to update Tylenol labeling, but conceded that there's conflicting literature and lack of clear causal evidence. So they think the tone of the release reads softer than we expected, and we think investors are getting a similar feeling reflected by the shares. So basically, they bounced in a big way after it went down a lot. They think our outlook on Tylenol or Kenvue has not changed since the Wall Street Journal first reported this issue back in September, and they reiterate our 24.5 fair value estimate for wide moat Kenvue. So there's a wide moat on the products that they sell. So this is an example of a stock that could be going down for no good reason, based on what Trump says. So I'm going to start buying 0.5% of this. That's like less than 1%. And if it goes down in half, then I'll buy another 0.5%. But that'll be part of my dividend, part of my portfolio. Okay, so let's look. Okay, so that's all I had to say for today. I hope you enjoyed that talk, and I hope you have a really good investing week going forward, and I'll see you next time.